What's going on, ladies and gentlemen? ANZD here with you, and in this video I'm going to talk about the Fed rate hike. Now, the Fed raises rate a quarter point, expecting ongoing increases. As the Fed rate hike, they promise to continue, well, not promise, but they probably going to continue to raise hike at the next meeting. One meeting will be coming up in March, and then the next meeting in May, and they look like they're going to continue to raise hikes, trying to impact, the inflation and make it more like of a softer, like saying like a softer recession. So the Federal Reserve's smaller interest rate hike could indicate that there will be some kind of inflation going on, and that is going to continue to slow down the inflation. But inflation is still going on, as well as there might be a recession. In the past Fed rate hike, it was lower and slower than the past. Well, the last one was about 0.25, but the months and weeks before that, they was doing interest rate hike at about 0.5%, which is about 50 basis points. But with this one, raises rate a quarter point. That means they're slowing the pace of hikes, which means the next meeting, they probably would just do a 0.25 hike, or basically a 25 basis points hike for the next upcoming meeting. So with the Federal Reserve raising interest rate hike, here's what the Federal Reserve interest rate hike might mean for you. There's going to be a lot of things, a lot of changes that's going to be happening. We're going to have more interest rate. You're going to have rents going up, mortgage going up, and not to include food and energy, which is not included in the CPI data, which the Fed go by. So we're going to see another 0.25% interest rate, because they're trying to get the Federal Reserve interest rate up to about 5.25%. So let me get more information of here's what we can expect of the Federal Reserve interest rate hike and what it might mean. So looking at some of the reports and some of the news that came out regarding the Federal Reserve interest rate hike, I'm going to check out this one with the Associated Press. Shout out to Cora Lewis for this one. Associated Press reported that the Federal Reserve raised its key rate by a quarter point Wednesday, bringing it to the highest level in 15 years as part of the ongoing effort to ease inflation by making borrowing more expensive. So that's the ultimate goal. They want to slow down people from spending, from borrowing money and spending the money, instead of just spending out of what you have in your account and things like that, because they're going to be increasing interest rate even more further going into the rest of the year. With the more rise in the Federal Reserve interest rate hike, it will bring up the interest rate for a lot of credit cards, a lot of loans, student loans, not exactly student loans, but car loans, credit card loans, personal loans, all kind of loans that's out there. The interest rate will go up because they are trying to slow down people borrowing and expense. They are trying to slow down making borrowing more expensive and have people unable to borrow as they were before. Now, the rate increase will likely make it even costlier to borrow for homes, autos, and other purchases. But if you have money to save, you probably earn a bit more interest in it. So what does that mean? Start focusing on more of where the Federal Reserve is placing their money, and mostly I think they're doing check out some bonds and things like that, and see where the Federal Reserve is putting their money, because if you're saving money, you want to put it where they're going to be earning interest on their money as well. Not financial advice, I'm just going off of some of the reports that I've read. The last rate increase is smaller than the Fed's half-point rate hike in December. See, so actually I was wrong. It was a half point, it was 0.5 in December. So that's why everybody was looking for more of a softer one than this one at 0.25. And it's fourth straight 3/4 point increase earlier last year. The slowdown reflects the fact that the inflation, while still high, is easing, and some parts of the economy seem to be cooling, but it still increased to a range of 4.5% to 4.75%. And many economists say they still fear that the recession remains possible, and with it, job losses, and could cause hardship for households already hurting by inflation. And you can see there's massive layoff going on. There's massive reduce on hiring people from big companies, especially the big tech companies. Also, we see that mortgages going up. You see rent is going up, and not to include, like I said, the energy costs and the food costs. So it's going to be very hectic for the next upcoming years. And remember, they will be increasing it more because it's going from 4.5% to 4.75%. And they're trying to get the interest rate up to about 5.25%. They're probably going to do 2 more interest rate of 25 basis. So within the Associated Press report, they had different key questions and things regarding of how the interest rate hike will affect people. So one of the key things they talk about is what's prompting the rate increase. Now, the short answer is inflation. Over the past year, consumer inflation in the United States is clocked in at 6.5%, a figure that reflects a 6 straight month slowdown, but still uncomfortably high because it's above their usual 2.5 inflation rate. The Fed goal is to slow consumer spending, thereby reducing demands for homes, cars, and other goods and services, eventually cooling the economy and lowering prices. Fed Chair Jerome Powell has acknowledged in the past that aggressively raising rates would bring some pain for households, but said that doing so is necessary to crush high inflation. And this is reported by the Associated Press. And we're going to continue to have more increase in the rate hike, like it said, just to crush high inflation. Things are, which consumers are most affected? Anyone borrowing money to make large purchases, such as a home, car, large appliances, will likely get a hit. The new rate will also increase monthly payment and costs for any consumer who is already paying interest on credit card debt. Wow. So that means try to get as fast as possible out of credit card debt, as fast as possible out of any kind of loans, because the interest rate will go up. Even on mortgage, even if you have a fixed rate, their mortgage might go up because of taxes and insurance. One person reported that it's already been really rough year with folks with credit card debt, and it's only going to get worse, said credit analyst Matt Schultz of LendingTree. The immediacy of the increase is what's hard, that it affects not just future purchases but current balance. That said, analysts noted that household debt payment as a portion of income remains relatively low, though they have risen lately. So even as borrowing rates steadily rise, many households might not feel a much heavier debt burden immediately. So even though it seems that you might not be in inflation, you probably won't feel it until a few months later on, down within a year or down within a couple of years. Other topic and focuses in the Associated Press news release report was also how will it affect credit card rates? How are savers affected? How will this affect home ownership? Will it be easier to find a house if I'm still looking to buy, if I want to buy a car? And I'm going to go over some more of these in a different videos. How have the rate hike influenced crypto? And I'm going to talk about that one in a few, so stay tuned. What about my job? And will it affect student loan and other things? So let's talk about crypto real quick, because I know some of y'all involved with crypto. So how have the rate hikes influenced crypto? Cryptocurrency like Bitcoins have dropped in value since Fed began raising rates. So have many previously high value technology stocks. And for crypto, it's also with the halving, the halving coming up, and the cycle will be coming up. So with crypto, you have your ups and downs with the volatility within the market. Higher rates means that safe assets like treasuries become more attractive to investors because their yields have increased. So that's probably where the Federal Reserve is talking about putting some of their money in treasuries. And I think he discussed that at the Federal Open Market Conference. At the Federal Open Market Conference, I believe they mentioned that they will be getting more involved with treasury assets. So treasury become more attractive to investors because their yields have increased. That makes risky assets like technology stocks and cryptocurrency less attractive. Still, Bitcoin continues to suffer from problems separate from economic policies. 3 major crypto firms have failed. Most recently, the high-profile FTX exchange, shaking the confidence of crypto investors. But recently, crypto investors are seeing a surge in prices, as there is some kind of run. It's not exactly a bull run because we're in a bear market, so you can say it's like a bull rally. Other things we're going to discuss in other videos regarding how this can affect your life. Is there any change in the rate hike will be reversed? Most likely not, and most likely won't be seeing any for this year. It looks increasingly unlikely that rates will come down anytime soon. We're expecting inflation will still be too hot for the Fed even by the end of the year, said Nationwide's Ayers. We predict it won't be until next year that they begin to lower rates. So once again, shout out to AP Business Writer for this one, and the AP Associated Press, Cora Lewis, the reporter, and many others. I hope this was of value to you and to others. Once again, Federal Reserve did raise interest rate hike by 25 basis points, increasing it by 25%, and they will be doing another hike in March at the next March meeting, and maybe also in May. So once again, it's NZD. Hope you got some value out of this. I'll talk to you later. Peace.